Why you need to have your mortgage paid off. All right, my man Tom writes in. He says, hey, long time no speak. He was a client of mine back a year ago. And he says, hey, question, pay off the house once we retire. And that was one of my suggestions. He goes, well, I'm happy to report that I'll be able to pay off the house in the next couple of months. My question is, Rich Dad Poor Dad is saying in his YouTube videos to always have debt and your house is just a money pit and causes cash flows in the wrong direction. Just looking for your confirmation that we're doing the right thing by paying off the house. All right, so let's dive into this. This is not Tom. It's not. He's not at fault here. It's the Rich Dad Poor Dad guy. All right. So what we're gonna do is we're gonna take old Bob Sample. All right, Bob Sample, and we're gonna say Bob is, how old we got him? He is 61. All right. So we're gonna say Bob is 61, and we're gonna go to net worth coming up here. And we're going to say he's got a house that's worth $250,000. All right, he's got a house that's worth $250,000, but he's got a mortgage on it because he listened to Rich Dad Poor Dad guy. He says, I want to have a mortgage on my house. So he's got $250,000 of a home, of which he owes $200,000 on it. We're just going to say he's making $2,000 a month, monthly payments. All right, so Rich Dad Poor Dad's guy says your house is a cash pit, as a money pit. You should have debt on it. But okay, now we're also going to say Bob has $250,000 in investments. Excuse me, that's the keyboard. Thank you. All right, $250,000 in investments. All right, so he could pay off the house. Yeah, no, we could not borrow against it, but he could take Social Security. His Social Security at his full retirement age is, we're just saying, $2,000 a month, which is the equivalent of his mortgage. Or he could just keep the mortgage and pay it on a monthly basis with money from his assets. All right, so let's take a look at what either way looks like. All right, so basically what happens here is if he's just going to pay money from his assets at $250,000, well, it's cost him $27,000 a year for mortgage, principal and interest plus property taxes. All right, and pull $27,000 a year out, he needs to pay $28,766. So it's costing him $1,700.66 in taxes every time he's pulling money out to pay his mortgage. So $1,766 divided by $250,000. So it's cost him about 0.75% of his total investment worth just to pay the taxes on his mortgage expense. All right. So this is going to make his portfolio hurt a little bit because he's having to pull out 28, 28, 28, 28, 28, 20. I mean, that's basically that's 150 essentially he's going to have to pull out of a $200,000, $50,000 portfolio. All right, so if you look at it, we say, okay, his ending balance, by the time that mortgage is, he starts taking Social Security, he's only down to 162. All right, let's keep going. So go back to cash flows. All right, so now his mortgage is paid off, thankfully, and thankfully he still has a little bit of money left, but you can see once Social Security kicks in, he'll start having more taxes. That's really neither here nor there for the mortgage, but you can see he does still get higher and higher taxes because that's what happens when Social Security, that's called the tax torpedo, butts up against your RMDs, your required distributions. But anyway, so it's costing him $1,076, $1,766 a year in which to pay for his mortgage. So that's a tax hit. Without question, it's also causing him $27,000 that he has to pay, he has to earn. Now he's got to get that money from someplace. If he gets it from his accounts, his IRA, it's going to cost him $1,700.66 in taxes to generate that $27,000 for which he has to pay the mortgage. Now, let's say instead he has an income. We're going to say he's got an income, and we're going to say he makes enough to cover his mortgage. He makes $27,000 a year as earned income. So he's going to look, man, and we'll just say calendar. We'll say he does that for 20 until 2030. All right, so right now he's making $27,000 a year, which is exactly the amount to cover the mortgage. All right, right. So let's take a look here. We go to retirement. We're going to go to cash flows. Good boy. So now he doesn't have to pull money from his IRA, so he can just pay it with the cash flow, right? Whoa, wait a second. Tax payment, $5,000. What is going on? What's going on, huh? Well, FICA taxes, state of Georgia taxes, federal taxes. So if we go up here to pay $27,000 of income in which to pay off a $27,000 a month $27,000 a year mortgage, he's going to have to generate enough money in which to pay 7% FICA, a little bit more, 3.4% to the state of Georgia, and 5.8% federal. So that's, let's see, that's 5 point, I take my trusty calculator, 5.8 plus 3.6 plus 7.1. He's paying 16.5% in taxes in which to pay that mortgage off. So even though he's generating $27,000 of earned income, he's got to pay tax on $27,000. So he still needs to come out of his portfolio with some amount of money which to pay the mortgage off. So we go to accounts. We're going to go ending balance by accounts. He's still got to withdraw $5,000 from his IRA because he had to pay tax on the earned income. So either way you're looking at, you're either going to pay tax on the money that you're earning in which to pay down the mortgage, and the tax is going to be income tax, FICA, and state income tax if you live in a tax state like Georgia. And in this case, the $27,000 of income doesn't even come close to covering the $27,000 of mortgage payment because he has to pay tax. So he's still going to have to pull out money from his IRA at $5,000. All right, now if it's just from an IRA, you're still going to have to pay tax by taking those distributions out anyway, simply because they're tax deferred, so you're going to have to pay tax on it. All right, so lastly, let's look at what happens if he doesn't earn an income. He just takes Social Security early. So we're going to erase this, and I'll wrap this up in a nice little bow for you guys to understand. So we're going to say income, I'm taking Social Security at 62. All right, so let's say I'm taking Social Security at 62. He gets $2,000 a month as his monthly benefit that's his PIA. So he's going to reduce it. So now we're going to see retirement because it'll be reduced because he's before the age of 67, his full retirement age. And then we're going to go to cash flow. So he's going to take Social Security at 62, but that still doesn't give him enough to cover the mortgage because he's taking it early. So now he's only got $17,000. He's still got to make up a difference of $9,400 from his portfolio in which to cover the mortgage. All right, now this isn't taxed because we can figure out provisional income. He's not paying any tax because that Social Security plus his $9,400 of distributions from his IRA doesn't give him any taxable income, which is good. But at the end of the day, he still has to live off other things. He still has other expenses, if that makes sense. Now, this will be taxed later, as you can see, because now he's got smaller tax payments, but he's not really getting all that much money from Social Security because he had to take it out early. Now, he'll be fine in the overall scheme of things, but still, this is what's called imputed income. All right, so when your mortgage is paid off, that means you inherently don't have to earn the money in which to pay the mortgage, which means inherently if you don't earn it, you don't pay tax on it. I cannot stress enough, this is kind of like when you grow your own food, for instance. Yeah, you do have to put the inputs in to get the seed, for instance, to grow it, but you don't have to pay sales tax or anything like that. You don't have to pay shipping. You can just go to your garden and grab a pepper and eat it. It's completely tax-free. It's imputed income, and growing your own food is imputed income, and having your mortgage paid off. That is just income you don't need to earn in which to buy something. And if you don't need to earn it, you don't need to be taxed on it either. I hope that makes sense. This whole thing with taking debt because your house is a cash pit, it's freaking stupid, man. It might be the most stupidest financial planning thing I've ever heard in my life. It goes on the lines as you need a debt in which you need a debt in order to deduct it. You need to borrow so you can have a deduction. That's freaking stupid. It's just dumb financial planning stuff, and it drives me up the wall. You want your house free and clear. That way you don't need to generate income in which to pay the mortgage. If you don't generate income, you don't have to pay tax on that income. All right, and frankly, even you still got, but in this case, we're just using a simple example of Bob having no other income sources, no other expenditures other than his mortgage. Well, he's obviously going to have other expenditures too, which is just going to add to the imputed income, or add to the taxable income he's going to have to do, because he's going to have to pull money out from other sources as well to which to put food on the table. Yeah, stupid. Anyway, so don't fall for it. All right, well, I'd love to hear your thoughts. We'll see you.